whenever an IPO comes, so promoters have to also contribute. Okay, so promoters contribute. So there is a rule regarding the promoters' contribution. The promoters of the issuer should hold at least 20% of the post-issue capital. So the promoters have to have at least 20% money put by them on the basis of post-issue capital. Okay, so whatever is the capital after the issue, they should have 20% stake in the company. Okay, that is basically to make sure the promoters are serious about the business and they have a large stake in the company. Okay. However, in the case of post-issue, shareholding the promoter is less than 20%. Suppose it happens the promoter's contribution is less than 20%, then they can seek the help of some others, like alternate investment funds or foreign venture capital investors or commercial banks or public financial institutions or insurance companies registered under with the IRDA may contribute to meet the shortfall in the minimum contribution as specified per promoter. So there are 5 or 6 entities which are allowed to help the promoters, so they can chip and bring their own money, and combined they should have 20%. That will be counted for the purpose of promoters' contribution, whatever they subscribe to the shares, subject to a maximum of 10% of the post-issue capital without being identified as promoters. So they can only contribute up to 10%. Okay, since they are not the promoters, so they can contribute. So the promoters shall contribute 20% as the case may be, either by way of equity shares or by way of subscription to convertible securities. So either they can buy shares or they can buy convertible debentures which are later on converted to shares. Even if they hold that, so for 20% counting, this even convertible securities will also be considered. Then promoters securities ineligible for minimum promoters contribution. Okay, so what are the securities which are not eligible? Okay, securities acquired during the preceding 3 years, if these are acquired for consideration other than cash, and revaluation of assets or capitalization of intangible assets involved in such transaction. If the shares have been issued by way of they were acquired for not for cash but by capitalizing their reserves. Okay, for example, revaluation of assets or capitalization of intangible assets like copyrights or patents. So by way if they are bringing in capital which is not in cash, so it will not be considered. Okay, or resulting from bonus issue by utilization of revaluation reserve, which means if suppose they had bought some asset earlier, a property, suppose they bought it for say 10 crores and today the value of the property is say 100 crores, so that means they can always boost up the balance of the assets by 200 crores. Okay, so 90 crores will be revaluation reserve which they can create in the books and enhance the value of the assets. Okay, so if any bonus issue is made out of capitalizing these kinds of reserves, then they will not be counted for the purpose of promoters contribution. Is that okay? If you have any questions you can ask me. Otherwise I'll think that you are understanding everything. Okay, Jumangni, you have lost your attendance for the day. कोई बात नहीं, एक मिस भी हो जाएगी तो कोई फर्क नहीं पड़ता. Okay, resulting from bonus issue by utilization of revaluation. So what we are doing is we are talking about promoters contribution. Okay, just focus here for the students who have just joined late. Promoters have to put at least 20% as way of their own money in any issue. Okay, or the post issue capital they should have 20%, and they can, if they are not able to put in, so they can seek the help of some other institutions which I talked about. Their contribution should not be more than 10%. Okay, now there are certain securities which are not eligible for promoters contribution, which are if they have acquired any shares preceding 3 years and it has been basically out of revaluation of assets. Okay, or a bonus issue which has again been issued out of the revaluation reserve will not be considered as a promoters for the purpose of counting the promoters contribution. Okay, then the specified securities acquired by promoters and those 5 people or institutions who are helping the promoters at a price lower than the price at which the securities are being offered to the public. Suppose if the promoters have bought shares in the preceding 1 year at a price which is below the issue price, current issue price. So even those securities will not be counted for the purpose of promoters. So suppose the promoters have bought some shares 1 year earlier, along with those five helpers, which you can help them to get them 20% on board. So those people, if they have bought shares at a lower price, suppose the company is coming with a share price of 100 rupees, and they have bought at 90 rupees in past. So those shares which they have bought less than the issue price of the current, public issue, so those shares will not be counted for the purpose of 20% contribution. Is that clear? Then specified securities, okay, that's I'm just leaving. You can just read it. Then we have specified securities pledged with any creditors. So that means if they have shares which they have pledged with someone for taking a loan, those shares will also not be counted. So if promoters have shares and they have pledged it with someone, like I can pledge my shares with a bank and take a loan from that. Okay. Suppose I need to invest some more money. Suppose I am having 10 lakh rupees shares, which I have done in past. So I pledged their shares with the bank, and bank gave me 7.5 lakh rupees, 75% of the market value of the, or 50% of the market value of the shares, which I was holding, so that I can spend that money for whatever purpose I need. So if I have pledged my shares, I am a promoter. Okay, those shares will not be counted for the purpose of promoter's contribution. Now here there is an exception. If the promoter has pledged the shares for a loan which the company is taking for the objects of the issue. Okay, that means whatever issue which is coming to buy assets, if the promoter has taken some loan and that will be used for buying some assets which are going to be used for the company, and that has been mentioned in the prospectus, then those are exceptions. Okay, the minimum offer and allotment to public in terms of, okay, so now we come to minimum offer to public. Now this is a very important a piece of law or regulation which says that some portion of shares of a company should be held by public. Not everything can be held by the promoters. So if a promoter is holding all the shares, it will not be getting listed. Okay, if it happens that it falls below a threshold limit, then that company will be unlisted from the stock exchange. Okay, so the public has to invest some portion, and they should always remain invested in a company so that it remains listed on the stock exchange. Okay, so the rule is, if you just read the second box, minimum offer to public at least 25% if the post issue capital is less than 1600 crores. So almost like 95% of the company in India, the issue capital is less than 1600 crores. So the one line answer is that public should hold at least 25% of the shares of the company to remain listed, or for coming up with this IPO. So at least 25% should be held by them. So it is written in long language on the first this thing, so you can just read it. Second is minimum offer to public at least rupees 400 crores if the post issue capital is greater than 1600 and less than 4000 crores. If the share capital of the company is issuing is above 1600 crores but less than 400 crores, then 400 crores should be at least with the public. Okay, but maximum will be 25% because most of the company fall into the first bracket. Then minimum offer to public at least 10% if the post capital is more than 4000 crores. So very big companies, maybe for Reliance or something like that. So if their share capital is above 4000 crores, then at least 10% should be with the public. Of course, there's one more band which has been added, which I have not written here. So we can just look at the regulations. So even beyond 4000 crores, there is one band there is a recent amendment which happened last year. So allocation in net offer main route. Now, whenever a company is coming with an IPO, okay, it has to issue shares. Okay, it has to issue shares to the retail investors. It has to issue shares to, HNIs, okay, which are called non-institutional investors, or qualified institutional buyers. All those 13 financial institutions in India who have been clubbed as QIBs. Okay, so in an issue made through a book building process under Rule 6, under sub-regulation 1 of the regulation 6, the allocation in net offer shall be as follows. So it says under the regulation 6.1. 6.1 means when the company has made, it's a profitable company, it has net tangible assets, it has operating profits, all the financial criteria is met. The company is, past track is profitable. Company holds assets, company is making profits. So if that company is coming with a public issue and if it is following a book building route, suppose they can even skip the book building route and come up with a fixed price rather than bringing a price band. So if they come with a price band and book building process, then not less than 35% to the retail individual investors. So at least 35% shares, not less than 35%, should be given to the retail investors, the normal public, and not less than 15% to the non-institutional investors. Okay. So who are NIs? Basically the HNIs, companies, individuals who have good net worth. Okay. But they are not classified as QIBs. Neither they are classified as RIs. That is the retail institute. So they are the mid category. Not more than 50% to the QIBs. 5% of this portion should be allocated to mutual funds. Okay. So this is when the company is profitable. First. Okay. The unsubscribed portion in either of the categories specified in A and B may be allocated to applicants in any other category. So if there is some unsubscribed portion in categories specified in A and B, then it may be issued to any other category also. Okay, fine. So this is what says the unsubscribed portion in either of the categories specified in A and B. A is basically RIs and B is NIIs, may be allocated to applicants in any other category. You have missed your attendance for the day. Okay, attendance you will not get. Okay, so all the norms such net worth, operational profit are met. So rule 6, regulation number 6, rule number 1 says that the company is profitable, then they can do this. This is the kind of allocation they can do when they come up with a share issue. Okay. So this is if they are following a book building route. Okay. Now, the second one is alternate eligibility route. That means companies doesn't have past track record, profitable track record. They have not made any profits, or they don't have any tangible assets. And the operating profit is not meeting the criteria which we did in an issue made through book building process as per regulation 6.2. The allocation in net offer category shall be as follows. Okay. So the 6.2 talks about when the company doesn't have any, they have not met the financial criteria. Okay. So, and they are coming with the book building, and they have to come up with the book building. So they can't avoid the book building route. Okay. So not more than 10% to the RIIs. So they can't offer more than 10% to the public, not to the public, but to the retail shareholders. Now, public may be even the HNIs also. So here, not more than 10% to the RIIs. So what can be the logic behind it? Why, the SEBI doesn't want that more than 10% should go in the hands of retail investors? Please raise your hands and tell me if you can just make a guess. It's a kind of, yeah. It's a risky company means it's the company which doesn't have a track record. The company is, not been profitable, like a Paytm or a Zomato and other things. So those companies were into heavy losses before they came for an IPO. So they came in an IPO, but they had to just offer not more than 10% to the RIIs, not more than 15% to NIIs, that is non-institutional investors, and not less than 75% to QIBs. Okay, so qualified institutional buyers. There are 13 such kind of institutions which are big in size. They can, understand, analyze a company. If they think the company has a good future, so they can invest. So if they have invested more than 75%, then of course, it makes sense for the public to also make. So this is only for those people. Okay, samely unsubscribed can be A and B can be taken by the QIBs. Then now we come to in an issue made other than through book building route. If you're not following the book building route, When you're not following the book building route because you're a profitable company, you have a good track record, so you can skip the book building route, but you still can go for a book building route as we have seen in the first listing. Minimum 15% to RIs. So minimum 15% to RIs, remaining to individual applicants other than RIs and other investors, including corporate bodies or institutions, irrespective of the number of specified securities. Okay, so they can then they can come up with this kind of a allocation of uh, net offer. Okay, okay. So I'm just going to skip some of the slides here and just going to just talk about a little bit about them. Exit opportunity to dissenting shareholders. If the company has not used the money for the objects for which the company has come with the issue, the shareholders can has been provided with an exit opportunity. So shareholders can claim refund from the company if they find that the money has not, because there would be a normal case, there would be a monitoring agency also which will be looking into the aspects of whether the company is spending the money for the objects of the issue. So if there is some kind of a mismatch or the company is not utilizing the money for the purpose for which they have raised the money, then there is an exit opportunity. Okay, fine. So who is a dissenting shareholder? Just read it, Zubin.
Dissenting shareholders mean those shareholders who have voted against the resolution for change in objects or variation in terms of the contract referred to in the offer document or the issue.
So company can say that we are altering the objects by passing a resolution in the board meeting or in the general body meeting. So the shareholders would say that we object to such kind of a change because the money the company has taken for, suppose, paying off all the loans. Some of the company has taken a 1,000 crore public issue and their main purpose was to pay all the loans to the banks, but they have not paid. And they say that out of that, 300 crores we are going to use for expanding the company. Okay, for that they need to first alter the objects by seeking a resolution from the shareholders in a meeting. So in that case, there would be some dissenting shareholders who would say that don't, like we want that the company should have paid all the money to the and paid off all the debt for the purpose of which they had come with the issue. So then they become dissenting shareholders. So then in that case, company has to return the money if they are not able to satisfy that. I'm just skipping that. Then preferential issue. Now company can come up with an issue of an IPO, FPO, a rights issue. They can also issue shares. It's called preferential issue. Instead of going to the public, they can just pick and choose people whom they want to like to give the shares to them. Okay, read Zubin.
Preferential issue means an issue of specified securities by a listed issuer to any select person or group of persons based on a private placement.
So it is called private placement basis. Sometimes company announce that we are coming with a private placement. So that means they are not going to issue shares to the public, not follow the regulations which we have studied so far. So they are going to just place it with certain people, some strategic investors. Okay, like Reliance say that they are going to give shares to Aramco group of say Emirates. They are going to put money into their company, and they can privately place the shares to them. Okay, fine. Read.
The listed issuer may make a preferential issue of specified securities if all equity shares allotted by way of preferential issue shall be fully paid up at the time of allotment.
So there are certain rules, how a company wants to come with a preferential issue, so they have to follow some norms. First is all equity shares by way of preferential issue shall be made fully paid up at the time of allotment. Special resolution has been passed by by the shareholders. So the shareholders, nod has to be taken before a company can go for a preferential issue. If the company says that we are going to issue shares only to a person A or B or C, then the company first should take the nod of the shareholders by calling the meeting and seeking their approval. So that is called a special resolution. That means 75% or more of the people, the shares holders, should say agree to that. Okay. So there are two kinds of resolution: ordinary resolution and a special resolution. The special resolution would be when 75% of the people who are owners of the company in form of, because they're holding shares, so they should give a nod that company can go for a preferential issue. Okay. Further, Zubair.
All the equity shares, if any, held by the proposed allottees in the issuer are in the materialized form. Issuer is in compliance with the conditions for continuous vesting of equity shares as specified in the listing agreement with the recognized stock exchange where the equity shares of the issuer are
So
listed.
that means all the shares should be in demat form. Now the share, nowadays all the shares are in demat. Okay, so there is no other way the share anybody can hold shares. And second is that there is another regulation called LODR, listing agreement with stock exchanges. So they have also complied with that regulation. What we are understanding is the SEBI rules, SEBI ICDR. Okay, and there is something called LCDR, something LODR. Okay, so that's another set of regulations. So that also they should have complied with. Okay, further.
The issuer has obtained the permanent account number of the proposed parties.
So whosoever is going to, take the shares of the company must take a permanent account number. It's a very simple one. Okay. Now we come to qualified institutional placement. So the yet another way of raising money is not going to public, not going to the issue the shares as a private placement, but go only to those QIBs, those 13 big institutions. You can even place your issue with them directly. Okay, read.
Qualified institutional placement means allotment of eligible securities by a listed issuer to qualified institutional buyers
So
on a
that,
private
yeah.
placement
So you
basis.
can even, place your, you can take money from those 13 big institutions, okay, which I have already covered in my past lecture. You might have gone through the video. So,
And includes an offer for sale of specified securities by the promoters and or the promoter group on a private placement basis.
so even the promoters can offer their sale, whatever shares they are holding. Okay, OFS, that means they can offer their existing shares to the QIBs. Okay, not only the fresh money which they can raise either fresh capital, or they can even offload their own share. They can dilute their holdings. What we say. Okay, fine.
Eligible securities include equity shares, non-convertible debt instruments, along with warrants and convertible securities other than bonds.
So they can offer convertible debentures. They can issue equity shares. They can issue warrants to QIBs. Okay, fine. Now I'm just going to skip that. Now there is a fast track IPO. Here also I'm just going to stick to some of the slides because the whole process is very long. When the company comes with an offer document, it makes an offer document with the help of the merchant bankers. Then it goes to SEBI. Then it has to give it to the public for their comments, and they have to wait for a long time before they can come with a public issue. So there is a fast track FPO. So it is only applicable to FPO and not to an IPO. Fine. So the company should already be in existence. Then they can be given an opportunity to come, and raise the capital without taking a lot of time and following all the procedures set by SEBI. So it is only the company which has a good track record. They don't have any kind of a legal, cases against them, and they are legally compliant. The auditors have given them a clean chit with regard to the balance sheet, profit loss account. There are no, objections, or no, what do you call? We'll just read that thing. Okay, okay, just read it.
An issuer company whose shares are already listed need not file the draft offer document with SEBI and obtain observations from SEBI or make a security deposit with the stock exchanges or its follow-on public offer (FPO).
So in this case, they are not, they don't have to file a offer document with the SEBI. Neither they have to deposit a security deposit, okay, and with a stock exchange. So these are the two things which are, advantages which are given to for the fast track offer. Okay.
If it satisfies the following conditions, the equity shares of the issuer have been listed on any stock exchange for a period of at least 3 years immediately preceding the right listing.
So that means this is only fast track offer is only FPO is only applicable to the companies which are listed in the stock exchange for at least 3 years. Their stock should have been listed in the stock exchange. Then only they are given this kind of a benefit. Okay, okay, just this is okay average. So and the average last one C1, read.
The average market capitalization of public shareholding of the issuer is at least 1,000 crore rupees.
So that means the market cap of that company who has been given this benefit of fast track, their market cap should be above 1,000 crores. So it has to be a decent size of company. 1,000 crores of shares of the value are traded in the stock exchange for at least last 3 years. Okay, so they can come within this thing. Okay, so there are some more regulations which you can read yourself. Okay, so this is the two more very important. Just read it.
Issuer has redressed at least 95% of the complaints received from the investors till the end of the quarter immediately preceding the month of the reference date.
So, which means that if there are some complaints received by the company from the shareholders with regard to their dividends or with regard to their any matter, so at least the company has satisfied 95% of the shareholders and addressed their complaints.
No show cause notices have been issued or prosecution proceedings have been initiated by the board and pending against the issuer or its promoters for old-time debentors
So,
as on the reference date.
so there should not be any legal case pending against the promoters. No cost shortages or prosecution proceedings. I mean, legal cases can be there, but no prosecution proceedings, no show cause notices have been issued to the promoters. Okay, just hold on. I'll just tell you. Now, suppose the company, if there's a case against the company, and the company has gone for a settlement, a compromise settlement with SEBI, that will pay you some penalty. You please let us go. So even if the company has gone for a settle, a kind of any dispute with any authority, and they have gone for some settlement mechanism to address that dispute, even those companies are not allowed for a fast track offer. Okay. So the KLM, or the last one. Just read the second box.
Impact of audit qualifications, if any, and when quantifiable on the audited accounts of the issuer with respect to those financial years for which such accounts are disclosed in the letter of offer does not exceed 5% of the net profit or loss after tax of the issuer for the respective year.
So when the auditors come and check the balance sheet profit loss account, they are supposed to give report. Okay. Now they can give a clean report. The company has, done everything. They have followed all the accounting standards, and all the books of accounts are showing a true and fair picture of the company, and all the assets and liabilities they have checked and they have found correct. Okay. So there is no qualification. But if they qualify, okay, if they qualify and say that out of the 100 crores rupees receivable from their customers, they have not checked them, and they are not very hopeful that they'll be able to get that money, and they have not even made any provisions for that. Suppose this can be a qualification. Subject to all this, other things are okay, but we have this qualified this thing. So company checks and says that company has to receive, say, 1,000 crores rupees from their customers. Out of that, say 100 crores is such which they can't verify whether they exist, those customers are there or not, and not they will be paying or not, and they have not got any confirmations from them. So they can have a lot of objections. So they can say, accept this, the rest of the things seems to be okay. So that objection is called qualification. If this qualification is going to have an impact of 5% or more on the profits of the company, then the company cannot come with a fast track offer. Okay. So it's written should not exceed 5% of the profits, which should be equivalent to that objection or the qualification. Okay. So now the most important one. So there will be a question in your paper with this from this. Okay. Fine. Can a company come with a SR equity shares? Okay, which are called superior voting rights. Fine. So sometime the promoters or certain set of shareholders are given superior voting rights. Normally a person who holds shares, if I hold one share, I'll have one voting right. But I can be a person, if I'm having one share, I can have 10 voting rights. Okay. So these are called uh, superior voting rights. So this can be given to some select few people. Okay. They can be either promoters or people who have, a great influence on the company's working. And if they leave the company, then the company can be in problem. Okay. Fine. Suppose you make a startup. Okay. You set up a company and you're a promoter. So as you're growing, you're raising more and more money, and you're diluting your shareholding because other people are coming and putting money. So your shareholdings comes down. So it falls, at a very low level. Then some other person can take over your company. To avoid such kind of takeovers, for the promoters who have started the company, okay, then they can be given some extra voting rights to protect them for such kind of takeovers by others. Okay, so this basically a protection shield to them. and this is given for only first 5 years of the company, and then it can be extended for another 5 years also. So let's talk about it. Read it.
SR equity shares means the equity shares of an issuer having superior voting rights compared to all other equity shares issued by the issuer.
Is that okay?
The issuer shall be intensive in the use of technology, information technology, intellectual property, data analytics, biotechnology, or nanotechnology to provide products, services, or business platforms with substantial value addition.
So only companies which are into such kind of business, okay, which are, the issuer shall be intensive in the use of technology, information technology, intellectual property, data analytics, biotechnology, or nanotechnology, or to provide products or services or business platforms with substantial value additions. So these special voting rights can be given to such kind of industries or people who are managing such companies. Okay. Fine. Okay, read further.
The SR shareholders shall not be part of the promoter group whose collective net worth is more than ₹1,000.
Okay, now suppose there's a company which is a manufacturing company like Tata Motors. They can't come up with and they can't give SR rights to their promoters because that is a manufacturing company. Maybe they're not getting qualified into the first one, which is they're not holding, this kind, they're not using all this which is written here. So those companies which are normally traditional manufacturing companies using, the conventional methods of producing their goods. So those companies will not be entitled to give to the promoters the special voting rights. Okay. Now, the SR shareholder shall not be part of the promoter group, shall not be the part of promoter group whose collective net worth is more than 1,000 crores. So he can't be part of the promoter group whose net worth is more than 1,000 crores. So it is not meant for people like Ambani's or Adani's or big promoters. Okay, it is meant for guys who are starting their businesses and they have less net worth. So either you are a promoter or a part of a promoter group whose net worth is more than 1,000 crores, then you can't be given SR voting rights. Read this.
The SR shares are issued only to the promoters or founders who hold an executive position in the issuer company.
So it is issued only to the founders, promoters, or executive like CFO, CEO, CMO. So all these people who are directors of the company, they can be given SR, special voting rights. Okay. Read further.
The issue of SR equity shares has been authorized by special resolution passed at the general meeting of the shareholders of the issuer, where the notice calling for such general meeting is specifically provided.
So this they have to call for a meeting, and a special resolution has to be passed in the meeting for giving some person a special SR voting right. So he's not going to participate in that meeting. He's not going to vote. So there is going to be all the shareholders will be called and says that this guy is to be given special voting rights. Okay, and then if 75% of the vote, they get 75% not from the shareholders, then that person will be given a special uh, voting rights. Okay. Okay.
The SR equity shares shall have voting rights in the ratio of a minimum 2:1 up to a maximum of 10:1 compared to the ordinary shares, and such ratio shall be in whole numbers only.
So maximum person can be given two voting rights. Minimum two. So if you're holding one share, you can be given two voting rights, or maximum it can be one share against 10 voting rights. 10 vote. So you can have your vote will be counted 10 times more than what shares you hold. Okay, fine. Suppose there is a company who has say a promoter who holds 20,000 shares. Okay. Now he's a guy who will be given a special voting rights, and the rest of the shareholders hold 30,000 shares. So altogether, 50,000 shares, 20,000 to the promoter, and 30,000 to the rest of them. So if he's given 10:1, so his shares will be equivalent to 2 lakh, and rest will have 30, isn't it? So overall voting rights will be 2,30,000, where he will be having 2 lakh. Okay. Now, if you just calculate this percentage, so 2 lakh divided by 2,30,000. So how much voting rights he has? Just tell me. Suppose the guy has 20,000 shares, he has 10:1 voting right. How much you get?
87%.
80,
87.
87%. Now, this is not allowed. It can't exceed 75%. Let's see that. It will be coming here. Okay. The SR equity shares shall be equivalent to ordinary equity shares in all respects except for having superior voting rights. So, for all other things, for dividends and other things, he'll be counted as one equity shareholder. Only for, taking some decisions and, if they are voting happening, so then his voting will be counted as per whatever rights he has got. Read second box.
The total voting rights of SR shareholders, including ordinary shares, in the issuer upon listing, pursuant to an initial public offer, shall not at any point of time exceed 74%.
So it should not exceed 74%. So in this case, example which I get, he got 87%. So this is not allowed. So his number of voting right has to be brought down. Maybe around 6. Let's try 6. So 6 into 20, 1,20,000 plus 20, 30, it becomes 150. So 120 divided by, what will be there? 150. How much you get? 80. So still it is not there. So maybe try now 4 times. 4 into 20, 80 plus 50, 130. So 80 divided by 130. Huh?
150.
Huh?
Ah,
Uh-huh. How much you get? 81%. Okay. So it's coming less than 74. So that is allowed. Okay. Fine. So it should not exceed 74%. Okay. Okay. Zubin, read.
the SR equity shares shall be converted into equity shares, having voting rights equal as that of ordinary shares, on the fifth anniversary of listing of ordinary shares of the listed entity.
So this is a sunset clause, which means after 5 years they will become ordinary shares with one voting right. So SR equity shares shall be converted into equity share having voting rights same as the ordinary shares on the fifth anniversary of the listing of the ordinary shares of the listed company. So after 5 years, his extra voting rights will be taken from him. So he will be like a normal ordinary shareholder. Aage?
Provided that the SR equity shares may be valid for up to an additional 5 years, after the resolution to that effect has been passed, where the SR shareholders have not been permitted.
So it can be extended for another 5 years. Okay, by a resolution, shareholders resolution. Okay, and where this guy is not present, his vote will not be. He can be present, but his voting will not be counted. Okay, okay. Now, sorry, this is the last one. Okay, now all the companies are supposed to give advertisements. Okay, whenever an IPO comes, so they give newspaper advertisements. So there is a pre-advertisement, pre-issue advertisement, and post-issue advertisement. Okay, just before the issue comes, they get advertised in the newspapers, and after the issue is over, shares are allotted, then they come up with a post-issue advertisement. Just read that.
The issuer shall, after registering the red herring prospectus or the prospectus with the ROC, make a pre-issue advertisement in one English national daily newspaper with wide circulation, Hindi national daily newspaper with wide circulation, and one regional language newspaper with wide circulation at the place where the registered office of the issuer is situated.
Okay, now once everything is done. The file now after registering the red herring prospectus or prospectus with ROC. So that means they have to file the prospectus with registrar of companies. After doing that, they have to make an advertisement in the newspaper. Okay, of this issue. So this is called the pre-issue. So what they have to mention that. Okay,
The lead managers shall ensure that an advertisement giving details relating to subscription, basis of allotment, number, value, and percentage of all applications, including ASV.
so they have to mention about how they are going to allot the shares, how much, what is their net offer, to whom what they will be offering. So all the details regarding this thing. Okay.
Number,
So this
value,
is after post issue. So this is now we are coming to the post issue. Yeah.
number, value, and percentage of successful allottees for all applications, including ASV, date of completion of dispatch of refund offers as applicable, or instructions to sell certified syndicate banks by the registrar, date of credit of specified securities, and date of filing of listing application.
So number and value of percentage of successful allottees. Who are the people? How much they have been allotted? Okay. and date of completion and dispatch of refunds, if any, if some people have to be given. So all that details will be given in the post-issue advertisement. Okay, next.
This
So
release
last etc. is released.
is released within 10 days from the date of completion of the various activities in at least one English national daily newspaper with wide circulation, Hindi national daily newspaper with wide circulation, and regional language daily newspaper with wide circulation.
So okay, so they have to do it within 10 days after the issue is closed and shares are allotted. So within 10 days they have to give an advertisement in the. Okay, the above mentioned details shall also be placed on the website of the stock exchanges. Okay, fine. So this finishes our uh, course for IPO. Okay, fine. So we'll have a small break